Hello again and welcome, and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We are headquartered in Arlington, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as the R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for Candace, please use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, a PDF of today's presentation is available for download now under Handouts, so should you wish to follow along or reference it afterwards. With that, I'd like to introduce our presenter today, Candace Orr. Candace is a Senior Director of Fixed Asset Consulting at Source Advisors, where she oversees tangible property regulations and fixed asset review projects and performs tax reviews and report certifications for cost segregation and TPR studies. She has more than 20 years experience specializing in the field of fixed assets. And with that, I will let Candace get started.
Hi, everyone. Thank you for joining us today. As we move into the presentation, I'm going to take myself off of video so I can focus on the slides. Thank you for joining us, and we'll get started. All right, so our agenda today is that we're going to first provide an overview of the tangible property regulations. We'll discuss the safe harbors. We'll get into the unit of property, major components, and discussions of substantial structural parts. We'll discuss the repairs versus improvements and how we apply those based on the rules set out underneath the regulations. We'll discuss dispositions, and if we have time, we'll walk through a few case studies. Brief interview. So first of all, why do we discuss the TPRs? Well, not all capital expenditures are eligible for bonus depreciation or Section 179 expensing. So identifying your capital expenditures that are eligible for expensing outside of whether it be repairs and maintenance or a few other under a few other authorities is best way to gas those expensing. Also, cost treated as repair expense instead of a depreciable asset avoids depreciation recapture upon the sale of property. And for most of taxpayers who had who were formed as a company in 2014, 2015, they were expected to file a Form 3115 to adopt the tangible property regs. However, that 5-year eligibility rule has now expired. So if you filed a Form 3115 with the $0 481 adjustment to worry about it later, we can now go back and kind of look and scope out those assets that were placed in service prior to 2015 that may be eligible for repairs. Polling question number 1.
All right, why discuss the TPR? A, state tax nonconformity for bonus depreciation. B, ineligibility of some expenditures for 179D. C, to avoid depreciation recapture. D, all of the above. And E, not applicable. This is our first of 4 polling questions. You do need to respond to 3 of 4 in order to receive CPA credit, that along with attending for 50 minutes. And it looks so far like D, all of the above, is what the audience is saying.
That would be correct. So the tangible property regulations, they were released, the final version was released in September 2013. Prior to that, we followed proposed regulations. The IRS started to see, several large firms filing large 3115 481 adjustments related to repairs and maintenance, some of them very aggressive positions. And so they decided it was time to tackle it and release the final regulations. And as part of that, what was the main change and what was included is, what was defining the unit of property. It also included definitions for material and supplies, expensing under de minimis safe harbor. It introduced the bar test, and it also addressed transaction cost. These were all applicable for taxable years on or after January 1st, 2014. Safe harbors. So when looking at your expenditures, one of the first things you want to do is look at whether or not those expenditures fall within any of the safe harbors that are outlined in the regulations. So whether or not the work or amount paid is a routine maintenance and safe harbor. So is that maintenance to keep the asset in its ordinary and operating efficient condition? So for non-building routine maintenance safe harbors, you have to be expected to perform that activity more than once during the unit of property's class life. And generally that is your alternative depreciation class life. So if you're repairing a compressor, what are you, is it general maintenance? What are you doing on that? Are you expected to replace that? Probably more than once in a 9-year class period. For your building routine maintenance safe harbor, that is expected to be performed more than once during the 10-year period beginning when the unit of property is placed in service by the taxpayer. And so normally some examples of those type of expenditures would be inspections, cleaning, testing, replacements of, small, comparable, and commercially available and reasonable replacements parts. So if you think of your normal inspections that you have throughout the year, any type of, landscaping maintenance work you do on an annual basis, replacing maybe coils or Freon in your HVACs, those are kind of typically what would follow underneath that routine maintenance safe harbor. There is a small taxpayer safe harbor. This is an election to not capitalize repairs, maintenance, or improvements. Taxpayers with a 3-year average gross receipt not to exceed $10 million. It is an owned or leased building that has a cost of less than $1 million. And most costs can't exceed more than 2% of the unadjusted basis of the building or $10,000. So the larger original building basis that you have, and the more expenditures that you use per year, you fall more away from the small tax safe harbor. It is an annual election, which is irrevocable, and you do it on it's a building by building analysis. So the de minimis safe harbor, this is an election, an annual election to apply a de minimis to deduct amounts paid to acquire or produce a property as a taxpayer does for financial accounting purposes. And the property must cost less than a specific dollar amount or with a useful life of less than 12 months. If a taxpayer has an applicable financial statement, they must have a written accounting policy in place at the beginning of the taxable year to deduct amounts that typically don't exceed $5,000 per invoice or per item. That can move, and that 5,000 threshold is based on whatever your capitalization policy or based on your revenue. And so sometimes we'll see taxpayers may have a higher threshold than $5,000 because it is a clear reflection of their business. And some go as low as $500 because that's a pure reflection of their business. Taxpayers who do not have an applicable financial statement, they don't have to have a written policy in place, but they do have to have a policy in place at the beginning of that taxable year that's consistent with the taxpayer's books and records. So they need to be doing it throughout the year. Typically, those amounts do not exceed $2,500. Again, it's an annual election that's a written statement filed with your timely filed tax return. It does not apply to amounts paid to land or rotatable, temporary, or standby emerging parts. It has to be property, so it has to be physical. When you think about when you're applying the de minimis, it's not used for things that it's not have a physical nature to it. Polling question number 2.
All right. What are examples of routine maintenance? A, inspections, B, cleaning, C, testing, D, all the above, or E, not applicable. And if you are not able to see the buttons next to the responses, make certain your brightness is up. Okay, let's see. Well, the majority say D, all the above. And I think we're all set.
Yep. All right. Unit of property. So what is the unit of property? Under the final regulations, the IRS decided to define what the unit of property was. Prior, your unit of property was the entire building. Under the final regulations, they decided to implement the building and the building system. So the unit of property is the reference point for which the capitalization standards are applied. The smaller unit of property, the more likely that cost incurred for the unit of property will have to be capitalized. The regulations set out 10 tests that are applied to each of the building systems. And if the cost is a capital expenditure for that building system, it is treated as an improvement to the entire building. So what are the unit of properties? So you have the systems, which is your HVAC system, plumbing system, electrical, elevators and escalators, fire protection and alarms, security for building, and then gas distribution. And within each one of those building systems, you do have major components that make up those building systems that you have to compare to. And if you're looking at an HVAC, that's your air handling system, your boilers, your condensing unit, your fans, your furnaces. Think of everything that makes up that particular system. Same with your plumbing and electrical, all your piping, wiring, lining, all of those make up that system and are either major structural components of that system or that building system, or they're minor components. So when you're looking at your capital expenditures or your renovation projects, you're applying what was paid, based on what your building system is. Your building unit of properties are going to be your building structure itself, your floor, walls, windows, doors, those type of things are your building structure, roof. Condos and co-ops are individual building unit of properties, and leased buildings or portions of buildings. Non-building unit of properties can include your plant property, network assets, or leased non-building property. For the majority of the type of studies that we do, we're focused more on the building unit of properties and those building systems. So what is a major component and substantial structural part? A major component is defined as a part or a combination of parts that performs a discrete and critical function. For a building major component, this may include all the windows, all the doors, all the roofs. For an HVAC system, those major components may include the rooftop units, the boilers, the ducting, all of that makes part of those major components. A substantial structural part is defined as a part or combination of parts that comprise a large portion of the physical structure of the unit of property. So from a building structure, that's going to be, you have your roof system, and part of that roof system has a substantial structural part that are the roofs and beams that hold that together. And so you have to look at, okay, what is the main structure that's holding this together, or what is the major component that if we took that out, it's not going to operate. There are restoration tests for the buildings that depend on the definitions of the major components and structural part as to whether it will be eligible for treatment as expense or capital. There are no bright line tests for determining major components. The regulations provide us a lot of examples, but clearly it's not, doesn't cover every aspect of a building or a project that we may encounter. Typically, the examples show that if you replace 30 to 40% of a major component, such as replacing 8 of 20 sinks, does not constitute a replacement of a major component. However, it does have explanations in there where if, depending on how many windows comprise, a building surface, whether or not that would be considered a major structural component or not. Multi-year projects are often must be considered in totality. Replacing 30 to 40% of a major component in 1 year may be okay, but if it's a precursor to replacing more of all major components over multiple years, it could constitute a replacement of that major component and must be capitalized. So if there's a planned rehabilitation to replace every single HVAC unit, then, not as they are broken or needed to be repaired, then that might trigger a capital event versus an expense event. Mostly for, analyzing your repair and maintenance as it relates to the tangible property regs, facts and circumstances is most important to understand that kind of intent as to why the replacement occurred. Repairs versus impairments. So under section 162, we deduct expenses are deducted for ordinary and necessary expenses, trade or business expenses, materials and supplies, and repair and maintenance. So those items fall under section 162. Under section 263, where we find the rules to capitalize are your amounts paid to acquire, produce, or improve ongoing property. If benefits extend beyond the current year, it adds value, prolongs life, or adapts the property to a new, different use. So as the rules apply, the regulations set out what was called the improvement test. And as you look at the expender, the first thing you do is you're going to define the unit of property in the applicable building system. So are we looking at the building or the building parts or structure? Or are we looking at HVAC, plumbing, electrical? Which system are we looking to? How are we applying that expenditure? And then we were provided 10 tests over 3 categories in which you have to apply the rules to determine whether or not to capitalize or expense. So the first one is adaptation of the unit of property to a new or different use. If you say yes, that it's a adaptation, then you have to capitalize. Is it a betterment to the unit of property? Does the work materially, is it an addition or an expansion to the existing property? Was there a defect or a material condition at the acquisition or at production? So was there amelioration? Will the work materially increase the quality, capacity, productivity, efficiency, or production of that unit of property? This third test is a restoration of the unit of property. And this gets into whether or not the replacement of the major component is a structural part. That's where your percentages come from of what, if you're replacing 20 to 30, 40% of a structural part, will it be considered an expense or capitalization? Gain or loss was taken on the component. If you had a casualty loss, all those things you have to apply these tests. And if you can say no to all the tests, then you can expense it. However, if you say yes on any one of them, you have to capitalize. Polling question number 3.
All right. Which is not a building system for repairs? A is plumbing, B is electrical, C is roof, and D, all of the above are building systems. And this is our third of 4 polling questions. You have to respond to 3 of 4 and attend for 50 minutes as measured by our software in order to receive CPE. And so far, people are slow to answer, but it appears that D, all the above are building systems, is winning.
Well, that would be incorrect. Roof would be the correct answer here. Roof is a part of the building structure, but it's not an actual system.
I think we're all set.
Okay. Adaptation. So with it, the adaptation is the amount paid to adapt a unit of property to a new or different use if the adaptation is not consistent with the taxpayer's ordinary use of the unit of property at the time originally placed in service. So some examples of new or different use would be you have a manufacturing plant and now you're converting it to a showroom place. You've developed land to use for manufacturing plant as residential housing. You have a retail drugstore that converts area of a walk-in pharmacy to a walk-in medical clinic. What's not considered a new and different use is if you have a retail shopping center and you have 3 leased retail spaces and you convert it into 1 retail space. It's still retail. You're still using it for its intended purpose. You're just reconfiguring it. Preparing your building for sales, so making some improvements to be aesthetically pleasing to a buyer. That is not a new or different use. Or a hospital that modifies its emergency room to also provide outpatient surgery. You're still preferring that medical service to exterior clients. One thing that we're seeing a lot currently is conversions of hotels into multifamily studios. That would be a new, different use, or a single family residential to a long-term long-term residential to a short-term Airbnb. That would be considered a change in use. And so in those cases, you would not be able to, anything would be eligible for repairs. Betterment. And some of these examples come straight from the reg, so you'll see the example too. So that's what we're referencing as an example that were, in the regulations. So if a capitalized event would be if you remediate land for contamination from leaks and underground gasoline storage. You buy the building, that condition existed, and so now you are going to you have to capitalize those costs. And a large expansion, increasing capacity. You add a stairway and mezzanine for the purpose of adding additional selling space within its building. So you're expanding, the interior square foot of the building. Anytime you add on to the building or expand that building where there was nothing there before, add a bathroom if there wasn't a bathroom, those type of costs related to those improvements will need to be capitalized. If you have a material increase in the quality, capacity, productivity, strength, or efficiency, an example to give the regs is reducing energy costs by adding new insulation. And so if it's not something that's like kind, that was not, that's readily available, and if it improves any of that, then you have to capitalize it. What is potentially, deductible repair costs? What's considered not amelioration of a pre-existing condition or defect is asbestos removal. So you go in there, you're doing a tenant finish out, you're doing an asbestos test, you found abatement of asbestos, so you perform abatement. That's a qualifying deductible expense. What's not an addition or enlargement to expansion is you remove a drop ceiling and then repaint the original ceiling. You're not adding anything. You're not increasing the capacity. And then what's not a material increase in the quality, capacity, or strength. If you replace 2 of 10 roof-mounted HVAC units, that is going to be a repair event. However, if you replace 4 of 10, then that might rise to the occasion of a a capital event. Remember, this is on a building by building basis. So each system within that building, you're applying these tests to. Some other examples for betterment that we see, we've seen over the last decade. So is, refinishing of floors. Anytime you're like refinishing, relocating, that asset was there before, you're just moving it to a new location. Those are going to be expense. If you replace, water piping in a kitchen, typically we would treat that as, water. I'm assuming they're not referring to it's attached to 1245 property in this example, but it's the least portion of the building and the plumbing system. So depending on what the materiality and the structural component of it, you could expense it. If you replace, anytime you replace all rooftop unit HVACs, that's going to be a capital event. If you lease a store and you paint the exterior of your leased portion of your building structure, that's going to be an expense. Almost always paint is going to be a expense activity, unless you've like completely gutted the property and removed all the drywall and the framing, and then that's a whole entire capital event. If you relocate and replace lighting fixtures, again, anytime you're just doing the relocation, that's going to be expense. And if you replace an entire roof, including the ducting, it's open to the sky, that's going to be a capital event. As part of the regs, they outline an example 6, 7, and 8, or 6, 7, and 8. They talk about certain stage or certain type of remodel versus refresh as to what would reclass as a refresh activity. In this case, they're using more of a retail store that has delivery in the back, but so typically your refreshes, splash and dashes, another kind of term we like to use. It kind of consists of either just a cosmetic or layout changes to the store interior and just general repair and maintenance to modernize the building. So in those cases where, you're replacing maybe some damaged ceiling tile, replacing maybe some flooring in small areas, power washing, painting, those type of things are refresh activities and not a betterment to the building. And so therefore you can expense those activities. And if you assume the same facts in 6, what they call a limited improvement is, okay, so you have assume the same facts in 6, and they're all ongoing on this, it's the same improvement plan. But you also increase the building's footprint by constructing a new loading dock, and you add a second overhead door, you upgrade the electrical system to provide lighting and power to the space. You could still capitalize those costs that are more aesthetic in nature, more refreshing activity. Those you can still expense, but those costs with the addition or the betterment, those must be capitalized in accordance with Section 263A. Now, if you have a major remodel, these are more where you think about gut remodels, and so you're replacing all the exterior walls with windows. You're rebuilding and removing walls. You're rebuilding the facade. You're replacing all vinyl flooring with ceramic tile, so it's not like kind. You're replacing, maybe certain top ceiling tile with acoustical tile, and you're remodeling all the bathrooms. All of those activities, it's affecting every system. So the physical nature of the work and the effects to each building system and structures is going to be a capital event. Restoration. So this is where we get more into kind of like the kind of like bright line test of threshold. But if you have a building structure and the roof, you're replacing the roof. If you're replacing the entire roof, decking, insulation, down to the structure, that's going to be a capital event. However, if you're just replacing a waterproof membrane with a new waterproof membrane or overlaying an existing membrane with the new membrane, that's going to be a repair activity. For your HVAC system, you have, in the HVAC system, you have a chiller or furnace, all your rooftop units, and all your ducting. If you replace one chiller, one boiler, and the boiler, those are going to be a capital event. But if you have multiple furnaces and you replace one furnace, then that's not a capital event. If you replace 3 of 10 rooftop units, that's where this kind of 30% test comes from. Then, you replace less than 30% of your rooftop units, and, with like kind units, same tonnage, that can be a repair activity. You replace wiring throughout the building to meet code. That's going to be a capital event. However, if you're only replacing 30% of the wiring to meet the code, then that could be a capital event, as long as it's kind of like kind, based on what the information we have. Plumbing system, you replace all plumbing fixtures in all restrooms, then that's going to be a capital event. However, if you're just replacing 8 of 20 sinks, then that's not going to be a capital event. And so we kind of use these examples from the regs to kind of give us a guideline as to where we can be, how conservative we need to be versus how aggressive we can be for certain building systems and structures. Typically qualifying repair and maintenance deductible expenditures. Again, for land improvements, for your non-building, if you're restriping, repaving, doing minor repairs to your sidewalk and curbing, or removal of landscaping, repairs, just minor repairs to irrigation systems, replacement of portion of fences, pool resurfacing, those type of site improvements and land improvements, over they're a 15-year life asset. So, those would be eligible for expensing. For personal property, typically each section of 1245 property has to be capitalized. However, if you're just refinishing or repainting cabinets, or you're relocating and reinstalling property, we can typically expense that. Some important special rules to recognize is that costs incurred during an improvement, if it directly benefits or was incurred by the reason of another capital activity, then the cost must be capitalized. So, if there was a leak in the roof and you end up replacing the entire roof, and then you're also replacing the drywall because of that leak, if you're capitalizing the roof because of that water damage, then that also has to be capital. So you kind of have to look at everything that's involved in, why it was occurring when you're looking at expenditures. For removal cost, if a taxpayer disposes of a depreciable asset, including a partial asset disposition, and has considered the adjusted basis of the asset of the component of the asset and realizing a gain or loss, the costs of removing the asset or component are not required to be capitalized. So basically, if you're removing carpet and you have a separate, demolition cost for removing carpet or removing flooring, and you're taking a disposition on the original asset to remove that for that flooring, then you can take the cost associated with removing that asset, the demolition cost associated with that, as an expense. A taxpayer may elect to capitalize expenditures for repair and maintenance, and that it's incurred in their trade or business. So, typically taxpayers are supposed to be applying these rules as they have expenditures, but they can also choose to capitalize repair and maintenance, because they're treated for at least 4 repair and maintenance expenses. You can capitalize for book and expense for tax. Unlike de minimis safe harbor, you have to book and tax have to match. So dispositions. They fall within the kind of tangible property regulation error, but it was its own separate piece of guidance. But as far as the partial asset dispositions, but the audit technique guide and several other things, I'll roll up the partial disposition language within the tangible property regulations. So disposition is a transfer of ownership of an asset or the permanent withdrawal of an asset from the business through sale or exchange, retirement, physical abandonment, destruction, transfer of supplies, scrap, or similar account, or the retirement of a structural component of a building or involuntary conversion. Dispositions apply to single asset accounting counts, multiple asset accounting, and general accounting rules. For dispositions of entire assets, these are not an election. Partial dispositions are, however, generally elective. However, if they're required due to casualty event, step and choose transaction, gain not recognized under Section 1031 or Section 1033, or is a sale of a portion of an asset. So generally, when we talk about the tangible property regs and you go through the process of applying your betterment test and you end up capitalizing, say, the roof that was torn off, you may have the option to take a partial disposition of that building for that retired roof, as long as it wasn't part of a casualty event where you took a loss. Method for identifying dispositions. The regulations require taxpayers to use any reasonable method to determine disposed assets in a GAA, MAA, or portions of a larger asset. The choice of a reasonable method is an accounting method election. So once you start using a particular method, you kind of have to stick with it. So some of the non-exclusive examples would be discounting the cost of the replacement assets to its place in service year using the producer price index, doing a pro rata allocation of the unadjusted depreciable basis based on the replacement cost of the disposed asset, or using a cost segregation study to identify that 1250 property at the time that you acquire the property. Therefore, when you do encounter doing a property improvement plan or any kind of renovation project, you'll be able to go back to that to your fixed asset register because you had a cost segregation study and individually identify those assets that were removed so that you can write them off. The partial dispositions are reported on Form 4797 in the year the property is removed and disposed of from the property. So it's super important that if you know that you're going to have a renovation event and that there could be potential for property for dispositions, that you make sure that you identify them in the year that they were removed, especially if you have a project that starts, say, like in September and demolition is finished and completed, before December, but your actual renovations are not going in service until the next year. You want to capture those dispositions on your say 25 tax return by placing the renovations in service in 2026. So it's very important to look at the timing of your large renovation projects to make sure that you're capturing, both the what you need for dispositions, capital, and expensing. When we look at demolition, one of the main things that we also need to be aware of is whether or not whether we're going to fall into a Section 280B situation. And this is where, you might have someone that's doing a demolition of a mall and they're redeveloping it. So they're going to, demolish, 1/3 or 2/3 of the mall to, maybe put up a hotel or something. So you want to kind of look at what's involved in the demolition to see if you're within this kind of safe harbor. So if it is considered demolition, or not considered demolition, if you retain 75% or more of the existing external walls, and 75% or more of the existing external framework. So another way to put it is if you're only retaining 25% of that original building, you're most likely in a 280B situation. And if you're in that 280B situation, it's considered demolition, not a renovation. And so you will not be able to use a partial asset disposition for that. You actually would have to recognize the adjusted basis of the building asset as land, and any demolition costs associated with that demolition will cost the land. So it's really important if there's like a very major structural that there's a large demolition to occur, to kind of look at your 2A Section 80B criteria to see if you fall into that. A GAA election is often a tax strategy that we see that's used when someone knows that they intend on demolishing a building. If you know that you're going to demolish the building, you can put it on you can elect the GAA election for that building, and that building will continue to depreciate even after, until you totally dispose of the entire land parcel, whatever. Generally, you need, the GA election has to be made in the year of the acquisition. So timing is very important on that. When the building is demolished, 280B will not apply. Instead, you keep on depreciating that building over time. So what sometimes the strategy is, you have the acquisition, you know you're going to do the demolition, you do a cost segregation study, and then you make the election to put the building, what's carved out from the cost segregation study. You put that building in a GAA election, you do a GAA election on that building, but your 1245 property and your 1250 land improvements, those will stay outside the GAA election and can be written off when they're disposed of. And you'll still be able to take the bonus depreciation on those items. Polling question number 4.
All right. Have you filed a TPR related 3115 since 2015? A is yes, B is no, C is I never filed them, and D is not applicable. This is our 4th of 4 polls. And again, you do need to respond to 3 of 4 and attend for 50 minutes in order to be eligible for CPE. And answers are rolling in, and they're kind of evenly divided between all 4, actually, with the winner being no by just a little bit.
Yeah. The further that we have gotten away from, well, I guess it's in between. So, you know, the further we got away from 2015, depending on how diligent taxpayers were of analyzing their capital expenditures, we're finding as we get further and further out that we're doing more of the analysis on some fixed assets, because it's kind of died off of those analysis on what really it is. And you have more people entering the market that may have never heard of tangible property rents, because it's, you know, now been over a decade. So it's, you know, kind of nuanced as well. So a few case studies. So these are just a few different properties types that we have performed some tangible property studies on, and the benefit that arises from using this particular tax strategy. And so most of these are a little bit, you know, pre-2024. So, but so we performed a study on a multifamily property that had $2.7 million in renovation costs that was placed in service in 2023. We were able to identify 35% into 15-year land improvement, about 5% in 5-year, and 31% into expensing. So, you know, if you put into the expense bucket, you're not going to face recapture if this property decides to sell. In addition, they had this would have been an 80% bonus year, so they took an additional $835,000 in additional bonus depreciation. And this was an increased cash flow of $599,198. And we were able to also identify $851,000 of disposed spaces. So those assets that must have been capitalized, we were able to go back to the original asset and dispose of $851,000. And so this resulted in an increase in cash flow of $599,000. Our second property type is an office building. This one had a renovation cost of a little over $2 million. It was placed in service in 2023, and we were able to reclassify all but 1% to 39-year property. So you got, you know, qualified improvement property, your 5-year, 7-year, all got a piece of that larger pie. Bonus depreciation of $1 million, and we were able to dispose $499,000 of that original asset. This was an increase in tax savings for this taxpayer of $688,976. Second, the third property type is a shopping center. This had a renovation cost of $1.7 million. It was placed in service again in September 30th of 2023. And we were able to move to a shorter recovery period or expense, about 89% of the total cost. $617,000 of bonus depreciation. So it was a tax savings of $497,000. With so much going into the expense, you're obviously going to have a less of a disposition basis because you can't do both. You can't take an expense and then take a disposition. But again, pretty good tax savings otherwise. So that wraps up our presentation. So we're about 15 minutes early, so we have plenty of time for any questions or answers, or I guess I give answers, but any questions?
I don't give TPR related answers, but we are just about 3 minutes yes, short of our 50-minute goal for CPE. So please, if you have any questions, and it looks like there is a question, which is appreciated. Candace, do you see it, or would you like me to?
Yes, I can see it. So if a taxpayer elects a higher capitalization threshold, the IRS allowed de minimis 5K instead of 2K. How risky is the IRS will disallow the higher threshold under audit? So I have not personally seen any push back on that. I often see more that the taxpayer has a lower threshold, so than what the IRS has set forth. But in the situations where we've had it, the IRS has not seen any pushback because it was a clear reflection of income. And so, they may have had a 5,000 or 10,000. Typically with your ones that file the applicable financial statement, they may, have already had discussions with the IRS, but I haven't seen too much. And I think it really just depends on the business and the income and that reflection.
And there is a second question from Ken.
Used source advisors before, but never saw the repairs to be broken out, be currently expense broken out. Is that part of a normal cost segregation service? No. So the your basic cost segregation service will only break out your 1245 and 12450 land improvements. If it was eligible for expensing, that would have been a tangible property study. So my group will usually scope those projects out and let our business developers know whether or not they're a good opportunity for a tangible property study where we would analyze the expense and the partial asset dispositions. And so if it was a situation where you acquired the property in the same year that you did the renovations, or the property was vacant, it might not have been eligible for repair and expensing. But no, it's not part of the normal cost seg service. It is a different service. Can you discuss how the de minimis election is applied when there is a significant remodel? So Carrie, normally when we're looking at renovations, depending on what type of property type it is, we will request the general ledger detail. And we look at the general ledger detail to see what the vendor and invoices are. So if it's under a general contractor's payment application, those you cannot cherry pick for de minimis safe harbor. But if you have items outside of that general contractor's payment application that's not soft costs, so they're owner hard costs, say you had some movable FF&E that you purchased, then we can look at those individual items to determine the de minimis safe harbor. So a lot of times for hotels, you have, when they're doing property improvement plans, there's tons of movable FF&E is purchased that have an individual price of less than $2,500 that we can capture under that threshold. So, we look at everything from the GL to what's provided to us to see if we can capture that. John asks, I'm sorry.
Yeah, no, I was just going to say you have 2 more questions.
So John asks, if you do a complete roof tear off, including decking and capitalize the repair, can you dispose of the old roof that was in the original building purchase? Do you need to do a 3115 in order to do this? So in order to capture that disposition, so yes, if it's determined that that roof is a complete tear off and replacement, then yes, you capitalize that old asset or capitalize a new asset. You can dispose of the old asset, but it has to be taken in the year that the asset is physically removed and disposed of the property. And so it would not be eligible. You can't do a look back study on dispositions. So you have to make that, and you can't file an amended return either for partial asset dispositions. So if you miss that disposition, then you lose it. You're going to have to depreciate 2 roofs. So it's going back pre-2014. But that's why it's important, if you know that these events are coming, that you're able to take that roof in the same year you do the expense, or same time you do the actual put on the roof. Nathaniel, sorry. If a taxpayer elects a higher capitalization threshold, the IRS allowed the minimus. Oh, we already did that one. Sorry. Teresa, if you're doing a big remodel project that will need to be capitalized, can smaller costs related to the replacing toilets be expensive? The toilets are under $2,500, for instance. Typically, it depends on how the remodel project is and the plan. So if it's a planned remodel to replace all the toilets and how it says, so you have to consider the install cost too. So if you're purchasing the toilets from Lowe's, but you have someone else installing them, does that individual cost exceed $2,500? Typically not. But there might, if there's a planned rehabilitation, then you might, and the GC and all that. So it's kind of facts and based on circumstances, but we have in the circumstances where that's the only thing that they're replacing your toilets, you can typically capitalize those, but you have to consider all costs that it takes to install those toilets. Ernesto, if one has an office space and increases the number of internal cubicles by remodeling the office, is this expense or can it be capitalized? So with the cubicles, that's 1245 personal property. So if those cubicles are more than your capitalization threshold, or based on whatever your capital threshold is, you would capitalize them. But you can expense them under de minimis safe harbor if that election is made and it's under 2,500 or 5,000, depending on whether you have an applicable financial statement.
Well, great. That is our last question. Thank you so much, audience, for participating. And Candace, thank you for your presentation.
Thanks, everyone, and have a wonderful rest of your week.
Bye.